Markets are now looking massively overvalued on a broad spectrum. We're now seeing Schiller's PE in the American market coming up to 36, which is absolutely huge. And I think it's fair to say that markets are starting to realize this and they are starting to sell off slightly. But it's around about this time now when the markets are massively overvalued that you need to be looking for stocks which look to be massively undervalued. And in this video, that is exactly what I'm going to be displaying to you. I found 5 stocks in which are some of my top picks for stocks which will go absolutely parabolic over the next couple of years. We have some ranging from London stocks to American stocks, energy stocks to finance stocks. We have it all in this video. It's quite diversified and it will be up to you to choose your favorite one. Now, it's clear to say I'm not a financial advisor. None of this is financial advice. These are just stocks in which I have picked out over my research over the last couple of days, where I have conducted intrinsic valuations. We've looked at market news. We've seen where these stocks are actually predicted to go. And it's clear to say that these stocks aren't just in the US markets. These are also some London stocks in which we are going to start off with some English stocks, which do have great potential. And if anything, these 2 English stocks look to be the most undervalued currently. But as we go on throughout the video, there is definitely other stocks which are massively undervalued. So let's start this off with Victrex. And don't worry, this is not just a PowerPoint. I will be showing you some formulas later and we will be going over their financials. But who are Victrex? Well, they specialize in chemicals. Their market position is leading manufacturer of high performance polymers. Their key financial levels currently is their stock price is at £7.84 and their estimated fair value is all the way up at £15.41, which is essentially a 50% discount currently. And they have massive growth potential with strong demand for lightweight materials and aerospace and automotive industries and expanding into medical applications for polymers too. It's clear to say that the valuation for this company could go absolutely parabolic in the next coming years as especially within engineering, these polymers, these lightweight polymers with a high tensile strength are going to be absolutely fundamental, especially in automotive and aerospace industries. So previously, Victrex has seen a massive high all the way up at $2,600 and right now it's all the way down at below $800. But spoiler alert, my intrinsic valuation formula actually calculates this to be way higher. And when I say dollars, just ignore me. And this is actually in pence. If you didn't know, London Stock Exchange is actually displayed in pence on Yahoo Finance. So it is actually £7, but let's just assume I'm saying dollars here. But if you are wondering if you go to buy these, that is why. So currently we see a price to earnings ratio of 23 and an earnings per share of 0.34, and this is why this stock looks massively undervalued, is because their next year growth rate is all the way up at 32.48%. So Victrex has a retention rate of 15.5%. They have a liquidity ratio of 2.1 pounds per pounds owed, and they have a free cash flow which is a positive, which is really ideal, and it does look to be somewhat increasing quarter over quarter, although in this case I think this is year over year. And as you can see here on an exponential moving average, it does look to be as if the stock is falling down, but it could be a good time to buy in. But for me personally, I don't like to buy falling knives. I like to see the stock bounce back before I do. But when I do see the stock bounce back, this does look to be a perfect pick. So looking here on a Graham's formula, we can see an intrinsic valuation on the left bullish side comes out to be $2,294 or pounds, and that would be 200 pounds or whatever it would be, and on the right here we can see 1,233 with the current price being set at 798. It's clear to say that this stock looks undervalued according to Graham's formula, and according to my own formula here, we can see that I yield a result of an intrinsic value of 2,410 and an acceptable buy price of 1,807. So this stock was actually featured on an article which says UK May 2025 stock picks that might be priced in below intrinsic value, and when I can find it, it's here. So here is where I essentially got the data for the PowerPoint there, where you see a potential 50% upside, but according to my formulas, it could go even further than that. Furthermore, on a MSN page here, we can see that based off of 13 analysts, the general consensus is for this stock to be priced in at a buy, and a high of 1,520 is a price target with a low of 780, which is just around where we are now. So it's fair to say that right now could potentially be the bottom for this stock, so it could definitely be a great time to buy in. And on a day chart here, we can see that on a exponential moving average, which this is the complete wrong one, but on an exponential moving average, it is of course below all of them currently, which is not ideal. I wouldn't actually buy into this at this current price when it's falling like this, and on a MACD it is definitely falling as well. So for me, I do want to see it hit a certain level of resistance and look to be as if it's going to start to climb back up before I buy in, but it does look to be massively undervalued, especially when you consider its previous highs way back in 2018. Did somebody say Just Eat? No, they didn't. They said Deliveroo, because Deliveroo is the GOAT in the UK for food delivery. Nobody actually uses Just Eat. We all actually use Deliveroo. But Deliveroo has actually been really poorly in the negative on their revenue for the last couple of years. And it's only just now that it's starting to enter into profit, which is really weird because I've seen Deliveroo around for a while. Fun fact about Deliveroo is when I was a first year uni student, I actually applied to be a Deliveroo rider. They sent me all the gear and then I never actually got to deliver anything, so it was a complete waste of time. And that's probably why they're not making much money, because they just give out all the bags and the clothes for no reason, and that's definitely not ideal. Deliveroo does actually have a certain aspect of risk around it, of course, because there is a lot of illegal workers potentially working for Deliveroo, and that is definitely something in which the government, I believe, is trying to crack down on. So there is, of course, that risk intrinsically linked to Deliveroo. But who are they for the people that really don't know? If you're an international viewer, well, they are a food delivery and logistics service. Shout out to the kebab that I used to get back in uni. Massive Deliveroo fan right here. Market position is a leading UK-based food delivery platform, of course. Their stock price is currently at £1.75 and their estimated fair value is at £3.04, which is a current 42% discount. Their potential growth is expanding into grocery and delivery partnerships and a strong user engagement and repeat orders. Guilty, that might be me. Not so much anymore, to be fair, but definitely in the past. So why isn't the valued? Well, market concerns over competition have led to mispricing, which I think is totally fair. So Deliveroo on a 5-year chart is down 47%, but on a 1-year chart it's up nearly 17%. So I think it's fair to say there is a bit of momentum behind it at the moment, and it does have an all-time high to catch up with, which is good because it means that the resistance isn't really there. So let's look at what I actually have for Deliveroo on an intrinsic valuation here. Quickly though, let's just go over their financials when this decides to fully load. So they are actually, as I mentioned, they are on a mean of a loss here of 7% over the last 5 years, but previously in this last year they are actually in profit now, which is good. They are really good on their liquidity ratio, and their free cash flow is actually pretty decent as well, with it jumping all the way up to 1 million, I think that is. And here you can see they are well above the exponential moving average. So let's go to the intrinsic valuation, because I'm sure that's what most of you want to see. So here we can see that Deliveroo on my system is priced in at a high of £325, but obviously then it's £3.25, but we'll just go 325. And then on the right it's priced in at 170 or £1.70. So it's fair to say that if you go in between these, it's definitely a buy. And on my actual formula here, I also have Deliveroo to be priced in at £3. So it does look to be quite a good buy at these levels. And again, this was something in which I found from this exact article as well, where Deliveroo is ranked all the way down here with a 42% upside. So I think it's fair to say that Deliveroo is probably a long-term gain. It's not something in which will go absolutely parabolic in this year, I don't think, but it will go quite big in the next 5, I would imagine, as their profit starts to take over. We are seeing a general consensus of a hold, with one putting it at a strong buy and one putting it at a buy, but 11 analysts are putting this at a hold at the moment, and there is a price target of a high of £2 and a low of 143. So it looks to be as if this stock is currently barely valued for its current position, but I think long term it looks to be something in which could go absolutely parabolic. Before we move on to Charter Communications, could I just get your opinion on my new logo? I've just designed this myself, and I think it's pretty nice. It's kind of the new color scheme I'm going for this channel. And if you are enjoying this video, please do subscribe to the channel, because it's something in which I'm doing for free. I don't even get paid off YouTube, and I've been doing this for 6 months now. I just enjoy it. So now we're moving on to Charter Communications. So moving away from UK stocks now, looking at Charter, we can see that this is a telecommunications and cable company. Their market position, one of the highest broadband and cable providers in the US, which is going to be massive going forward. Their key financials is their stock price being at $427, their market cap at 67 billion, and their PE ratio, which is currently at nearly 12, which is lower than the industry average, indicating that it is undervalued. And as we'll get onto my intrinsic valuation formula later, you'll see with their growth combined, it does definitely look to be undervalued. They have a really strong growth potential as they had a merger with Cox Communications valued in at $34 billion US, expanding market reach. They had a strong Q1 earnings with an earnings per share of $8.59, which exceeded expectations from the analysts, and a revenue growth driven by mobile service expansion, which is always just going to be something in which is massive within the world going forward, probably for the next 20 years until some sort of new communication comes along where we're all just talking telepathically or something stupid. So over the last year, Charter is up 51%, and it is actually down 20% over the last 5 years. It currently is obviously at its PE ratio of 11.44 and an earnings per share of 35 at $409. Over the next year, we can expect Charter to grow 17.65% according to the analysts. And of course, now we're looking at US stocks, we can actually see surprise rates, which is very nice. Their financials are really good, but we'll get into this now in a bit of a deeper dive. So looking at their retention rate here, it is around 9% on a mean over the last 5 quarters. We're looking at quarters now, not years, because it's a US stock. We can see a liquidity ratio, which is absolutely pants. That is really not ideal for them, but they do have a really good free cash flow to back up their really bad liquidity ratio. So that is actually more valuable in many investors' eyes. And here on a 365-day exponential chart, we've seen that it is now above the exponential moving average. The probability of a positive day, now we're doing a US stock, we can do this, is 52%, and a negative day is only 26%. Which does indicate that you are more likely to see a positive return within this stock if you hold it for a little while. And looking here on the Graham's intrinsic valuation, I have a bullish result of $1,414 and a bearish result of $797, with the current price being in at $409. It's fair to say this stock looks massively undervalued, and according to Peter Lynch, it's also ranking at a score of 3, which indicates that this stock is very undervalued. And according to my intrinsic valuation formula, I yield a result of $1,463 with an acceptable buy price of $1,094, indicating again this stock is massively undervalued. Where this stock doesn't look massively undervalued is their free cash flow, where over the next 9 years this stock's free cash flow will price this share. Oh my god, I stuck between saying share and stock then. Their share will be worth $732, and for this year it should only be priced in at 81. So there's the final results for this. I will go over a conclusion at the end of this video, but it's fair to say that Charter Communications does look to be quite undervalued, especially for this year's growth, according to everything apart from its free cash flow. So looking here at Constellation Energy, this is an energy and utility company. Their market position is a leading provider for clean energy solutions such as nuclear power. Their current stock price is $291. They have a market cap of $89 billion, a PE ratio of 30.5, which is above the industry average of 20.9, indicating a strong valuation potential, or the fact that it's overvalued, which we'll be getting onto later, of course. They have a lot of growth potential, with the revenue growth being over 10% year over year, earnings per share going up 17% year over year. They have strategic acquisitions where they have acquired Capleen for $16.4 billion, which is actually expanded into their clean energy portfolio. They have nuclear expansion, specifically with PJM, selected KEGS, Crane Clean Energy Center for expedited grid connection. Price targets for this stock are very mild, to be fair. We have a price target on an average barely just above where we are currently, and a high of 375, which is relatively quite far ahead even for my formulas. They are outperforming their sector, of course. They've gained a 21% year to date on their stock price, while the broader energy sector has declined by 5.8. And momentum investing appeal as nuclear energy stocks, including KEG, surged recently due to rising demand. So Constellation is ranked in as a general consensus of a buy based off of 16 analysts, with a price target of a high of 385 and a low of 184. I think it's fair to say it does look to be a relatively solid buy. And over the last year, they are up 32%. And from the previous 5 years, they're actually all the way up at 667%. And I think that just goes to show the demand for clean energy within the US specifically now, and going on later into the world. So I think it's fair to say this stock looks to be something in which is fair to be parabolic over the next few years. Okay, so looking at Constellation Energy's financials, we've got a retention rate of 13% over the last 5 quarters, a liquidity ratio which is really not ideal. It's all the way down at 0.18, which is not good, and a free cash flow which is steadily somewhat increasing, but it is still negative, so there is definitely a lot of drawback for their financials. However, I think it's fair to say that going forward, this company does look to be as if their financials will definitely improve, just because of the expansion of clean energy within the United States. Looking on a 365-day exponential chart and the volume, these two are correlating relatively nicely, suggesting that the price is somewhat supported up until a point. Maybe the last bit of recent growth might not be as supported as it would like to be. And looking at a probability theory here, we have a probability of a positive day at 54% and a negative day of 32%. So that indicates that you should be all right if you are in this stock. We have a growth rate over the next year of 16%, if you can see that, and a mean surprise rate of 5%. So it's fair to say it is definitely growing in the right direction. Maybe not as much as some of the other stocks in this video, but it is definitely growing. So looking at an intrinsic valuation for this company, we can see here on the left that I have an intrinsic value on the Bullish to be set at $368, and on the right of 208, which is obviously well below where we currently are. So according to Graham's formula, Constellation Energy does look to be overvalued to an extent. But when we go over to my formula, which includes WACC rates, probability theory, free cash flow, and everything like that, I yield a result of $423, which indicates this stock looks undervalued. And of course, their free cash flow analysis is really not ideal, but it's fair to say that because their free cash flow is consistently negative, it's always going to look bad. So Constellation, they might not be intrinsically undervalued for this year's growth compared to the other companies in this list, but I think that with their clean and green energy initiatives within the States, I do think it's fair to say that this company should go absolutely parabolic over the next 5 years as it just expands out. So the final company for this list is probably what a lot of you have been waiting for, and it's SoFi. I've been a SoFi fan for a while now, and it's still not going back up. I mean, it's climbing up, but it's falling back down, and I do think this stock is massively intrinsically undervalued, as we will get onto later on in this analysis. But they are a fintech and digital banking company. For those who don't know, they offer leading financial services. Their platform offers loans, banking, and investing solutions. They have a stock price currently of $13.92. with a market cap of $14 billion and a current PE of 30. They are a potential growth driver, with revenue growth coming in at 33% year over year, reaching $771 million. Earnings per share is currently at 0.06, which is up 200% year over year, and they have an expanding customer base of 10.9 million members, which is up 34% year over year as well. Not to mention, they are very diversified within their revenue streams, such as lending, financial services, and technology platforms. They are, of course, very rate sensitive, as when the Fed cuts rates or increases rates, their stock price does definitely become affected. Why are they undervalued? Well, strong analyst ratings, average price targets of $14.17 with a high of 20, and I'll be honest, mine is way higher than that. Technical indicators, which are very bullish. The stock has formed an inverse head and shoulders pattern, signaling a potential upside going forward, and momentum investing appeal as RSI nearing overbought levels, indicating strong demand for the stock. But as we can see, on its day chart here, it is definitely not doing too well as of right now within the last couple of days, as it has fallen back down, but it is definitely looking to be as if it can go back up. We need to get like a hammer little gif here and just smack it up, to be perfectly honest. So for the financials of SoFi, we have a retention rate currently of 16.2%, which is huge for SoFi. They were founded in 2011, so it's fair to say they've been on the block for a while, but that is still a really good retention rate. They have a mean liquidity rate of 10.88, which again is really, really good. We do like to see that. And where this company is definitely lacking is their free cash flow, as it is increasing somewhat quarter over quarter, but it is still definitely in the negative, and that will definitely affect this company's valuation. On a 365-day exponential moving average here, we can see that they are well below the exponential moving average, indicating that we can probably expect to see SoFi catch back up with this trend line, maybe within the next couple of months, hopefully. And on a probability theory, we have a probability of a positive day to be at 52% and a negative day to be at 37%. Now, SoFi is expected to grow at 67% within their actual overall revenue year over year for the next year, according to the analysts. And they are having a current mean surprise rate of 51%, which is absolutely huge as well. So on Graham's formula, I currently yield a result of, when I can actually find where I am, of $81.83, which is obviously way above where we currently are. And on the right bearish formula, I have this to be set at $41. So it's fair to say SoFi is definitely undervalued, according to Peter Lynch's valuation as well. This stock just seems to look massively undervalued as well. Going forward onto my own intrinsic valuation formula, I get a result of $93. So I think it is definitely fair to say this looks massively undervalued. But when you do account for their free cash flow analysis, their discounted free cash flow, it's definitely something in which we can't really conduct, because their free cash flow is consistently negative, and it is something which we would like to see them fix. But obviously short term they are definitely improving a lot, so it's fair to say that it's something in which we're not probably going to see for probably a couple of years for it to be consistently positive. So with that being said, that is SoFi. So that will conclude this video, but I will just quickly go over this very briefly again for you. Looking here, this is essentially all of them which I have conducted, not just specifically for this video, but in general over the last couple of months. And it's fair to say that these were some of the top picks. So let's go over them one by one again, just very briefly. So Victrex does look to be massively undervalued. It's definitely in a long-term and very quickly growing industry. And according to a lot of analysts, it looks massively undervalued. Deliveroo is breaking into profit in the next couple of quarters, hopefully, and they do also look massively undervalued according to the analysts, and their growth rate is going to be absolutely fundamental for them going forward. Charter Communications is going to be huge going into the future as well for the US, and it's fair to say this stock looks to be one of the most undervalued for the long term for sure. Keg doesn't look as undervalued currently, but I think it's going to be fundamental for the US going forward with clean and nuclear energy. And SoFi breaks my heart every time I talk about it, because it should be so much more than it is currently. This is probably one of my favorite picks, maybe after Victrex. I don't really have a personal favorite, but let me know in the comments, what is your favorite out of this video? I would really like to know. And I would like to say again, I'm not a financial advisor. None of this is financial advice. This is not to say these stocks will go parabolic, but it's me basically saying that they are set up in a good position to hopefully go parabolic. I hope you have enjoyed this video. Again, these videos are completely free to watch, so if you could share this, like, subscribe, it would be greatly appreciated, and I'll see you for the next video.